Pause for a moment and distance yourself from your computer screen immediately. You must remain composed and step away from the ledge before your fingers touch the liquidation trigger on your trading platform. Because if you exit your positions this afternoon, if you stare at that crimson tide across your portfolio and surrender, you are doing more than just losing capital. You're stepping straight into a complex psychological ambush orchestrated by global monetary authorities. You are the prey in this scenario, and as of this second, the predators are feasting. Welcome back to the channel, Commodity Advisor. It is currently Monday, February 2nd, 2026. If you have glanced at the charts recently, you probably feel a knot tightening in your gut. You are witnessing a total demolition. Gold has been hammered down by 13%, fluctuating near the $4,750 mark. But silver? Silver has been dragged out to the clearing and liquidated in cold blood. It is crashing 36%. We are seeing it hover around $83. Only a few sunrises ago, the community was celebrating the $100 milestone. We were anticipating a vertical launch to the stratosphere. Now, corporate media outlets are performing a victory dance over what they call the corpse of the precious metals cycle. The talking heads on television are flashing graphics that scream about a punctured bubble. The major financial journals are publishing opinion pieces claiming that liquidity is the only sanctuary left, and they have found a fresh protagonist to credit for this carnage, a figure named Kevin Warsh. The fairy tale they are broadcasting today is simple, tempting, and fundamentally fraudulent. They expect you to believe that the arrival of Kevin Warsh, this supposed new enforcer of monetary discipline, signifies the end of the commodity era. They want you to think he has the power to siphon off the excess cash, fortify the dollar, and extinguish the flames of inflation. They are preaching that the professionals have regained control and that possessing physical bullion is foolish compared to holding onto Federal Reserve notes. This is a psychological operation. This is high-level cognitive combat intended to detach you from your generational wealth. Observe the price movement closely. Does a collapse of 36% in a single trading session look like natural market behavior to you? Does it appear to be the result of organic divestment? Do you genuinely think every silver stacker on the planet woke up at the same hour, saw a social media post about Kevin Warsh, and simultaneously decided to dump their family security? No. Markets do not descend in perfect vertical lines unless they are being shoved by a massive force. This was a synthetic paper destruction. This was a synchronized liquidation of billions in nominal futures contracts. These are digitized promises that possess no physical weight, dumped onto the exchange at the exact second of maximum market fragility. They hovered until the Eastern exchanges were inactive. They waited for the thin liquidity of the pre-dawn hours, and then they hammered the bid price. They struck it repeatedly with no mercy. They initiated a cascading liquidation event. They specifically hunted the automated sell orders of high-leverage participants. When the valuation touched 100, the floodgates opened. Panic sales generated further panic. At $90, the margin calls were issued. Now, at $83, they have successfully manufactured total hysteria. But pause and ask, who is on the other side of these trades? If every transaction requires a taker, who is holding the bucket to catch these falling blades? Is it the everyday small investor? No, he is paralyzed with fear. Is it the institutional pension fund? No, their committees are too sluggish. It is the major bullion banks. It is the precise entities that designed this collapse. They are crushing the paper valuation to acquire the physical substance for a pittance. They are establishing a private bargain basement for their own books. They understand that at $83, silver is the most undervalued commodity on the globe relative to the total currency supply. But they cannot seize it unless you agree to part with it. Therefore, they must terrorize you. They must convince you that the economic laws have been rewritten. They must brainwash you into believing cash is superior. Do not fall for the deception. This decline is not a mirror of physical reality. It is a mirror of the derivatives architecture. It is a digital hallucination designed to obscure a tangible crisis. While the ticker flashes 83, go try to source a 1,000-ounce bar for that price today. Go ahead, attempt the purchase. You will discover that the physical street price has not moved an inch. You will see that the major distributors are completely stripped of stock. You will find that the gap between the artificial price and the actual cost of metal is wider than a canyon. The snare is prepared, the exit is narrowing. And if you run through it, if you swap your gold and silver for melting paper today, you will remember this day as the most tragic error of your financial existence. We must deconstruct the physics of this robbery. We need to clarify exactly how they utilize the derivatives market to simulate a bankruptcy. Let's move to the second chapter. Let's inspect the evidence at the crime scene. This was a robotic invasion. To comprehend the offense, you must first comprehend the instrument of the crime. The tool is known as the futures obligation. A futures contract is not a bar of silver. It is a speculative wager on the direction of silver's price. It is a legal document stating, "I vow to settle silver at this cost in the future." But here is the scandalous truth. You do not need a single grain of silver to sell a contract. You only need a small deposit. You only need a sliver of collateral. If you are a dominant bank or a market maker, you can generate these documents out of nothingness. You can manufacture paper supply without limit. So here is the play-by-play of what occurred at 3 in the morning New York time. They waited for the physical centers in the east to go dark, but before the London desks were fully operational, they targeted the liquidity vacuum. And then they initiated the dump. They didn't move physical gold. They sold tens of thousands of digital tokens in a blink of an eye. They saturated the trading algorithms with sell signals. The computer sees this avalanche and assumes that the entire world is fleeing, so the price sinks. It drops from 120 to 110. This is where the trap clicks shut because you, the retail participant or the fund manager, have stop-loss triggers. You have a preset command in the system that says, if the valuation hits 100, sell my entire stake to save me. When the bank forces the price to par, they ignite your sell order. Your own computer sells you out. This drives the valuation to 95, which hits the next person's trigger, dragging it to 90. It is a chain reaction of failures. It is a liquidation waterfall. The banks didn't need to sell the whole way down the mountain. They just had to tap the first rock. The software did the rest of the work. They weaponized your own risk management against you. And here is the brilliance of the theft. While the paper value is disintegrating, while the screen is blinking $83, what are the bullion banks actually doing? Are they divesting? No, they are accumulating. They are waiting at the base of the waterfall with an open vault. They triggered your exit so they could buy your paper at a 36% discount to balance their own short positions. They coerced you into selling at the bottom so they could buy the bottom. They sanitized their balance sheets. They eliminated their risks. And most critically, they severed the link between the paper price and the physical world. Because while the monitor says silver is crashing, the tangible metal remained unchanged. The silver mines did not discover a massive new vein last night. The green energy sector didn't stop requiring silver for panels. The physical deficit we analyzed all month, the empty depots in Shanghai, the gridlock in Hong Kong, that remains the absolute truth. Nothing shifted in the material world. Only the digital world shifted. And they are betting their entire reputation that you are too distracted to spot the difference. They are gambling that you will see a falling line and conclude that silver is trash. But the most perilous part of this psychological operation isn't the price action. It is the narrative they are feeding you. They require a cover story. They cannot simply admit to manipulating the exchange. So they are wrapping it in a political flag. They are using the name Kevin Warsh. They are telling you that this person is the savior of the currency. They claim he will siphon the liquidity and make your dollars precious again. We have to address this falsehood. We have to explain why no single man can rescue the dollar. We must highlight the $38 trillion debt cage that makes sound money a mathematical impossibility. Let us advance to Section 3. Let's look at the cold numbers. The paper destruction is merely the mechanism. To see the trap, you must see the intention. Why are they crashing the sector at this specific moment? Why are they forcing this cash is king rhetoric into your mind? Because they need your faith in a fantasy. They need you to believe that the new leadership has a supernatural ability. They want you to believe that he can just snap his fingers, drain the ocean of cash, stop the inflation, and bring back the dollar's glory without incinerating the global economy. This is the legend of Paul Volcker, and it is the most toxic myth in modern finance. Let me provide a reality check. In the year 1980, Paul Volcker moved interest rates to 20% to kill the inflationary monster. It was successful. It was agonizing, but it worked. However, here's the discrepancy. In 1980, the American debt to GDP ratio was a mere 30%. Today, it exceeds 120%. Back then, the national debt was under $1 trillion. Today, it has surpassed $38 trillion. Do you perceive the mathematical wall? You cannot utilize the Volcker strategy when you are suffocating in debt. It is a physical impossibility. Here's the debt spiral the media is hiding from you. If Kevin Warsh truly executes his plan, if he maintains high rates and drains the banking system to protect the dollar, he will bankrupt the United States Treasury in less than half a year. Why? Because of the interest burden. When the state carries $38 trillion in obligations, every single percentage point of interest adds nearly $400 billion to the yearly deficit. If rates remain at 5% or climb, the interest cost by itself will devour the entire tax collection of the nation. The government would be forced to borrow fresh money just to pay the interest on the old money. It is a terminal cycle. It is a giant Ponzi scheme reaching its logical conclusion. And Kevin Warsh is aware of this. He is a sophisticated banker. So why the aggressive posture? Why the market crash? It is a giant bluff. It is a strategic head fake. He is deliberately inducing a deflationary shock. He is crushing gold, silver, and equities to create a smokescreen. He wants to fracture the market. He desires to see prices tumble. Why? So that when the machinery inevitably breaks, when the lending markets freeze or the bond auctions fail because the world has no cash, he can pivot. He can turn to the public and say, "We have an emergency. We have a deflationary collapse. We must inject liquidity to save civilization." He is engineering the catastrophe so he can be the hero who prints the antidote. This crash is not the conclusion of the inflation. It is the compression of the spring. Visualize a heavy coil. To make it leap to the ceiling, you must first push it down with all your weight. You have to store the energy. They are storing the energy in gold and silver right now. They are using the war story to compress the valuation. But the second the pivot occurs, the second the debt market snaps and the digital presses resume their work, that spring is going to explode. And it will explode with the momentum of $38 trillion of fraudulent debt pushing it from behind. So when you hear people say, cash is king, you should interpret that as cash is king for exactly 15 minutes. It means cash is the leader until the Treasury realizes it cannot meet the payroll. And after that, cash is kindling. Then we transition from deflation to hyperinflation in a heartbeat. The current sell-off in metals is just the market misjudging this upcoming reversal. The traders think Warsh will win the fight against inflation. The math proves he has already lost. And when he admits defeat, he will fail in the direction of printing. He will be compelled to manufacture more currency than every central banker in history combined just to keep the lights on. This leads us to the most critical query of the day. If the elite money understands this, if the insiders recognize that the deflation is a fabrication, then where is the capital actually flowing? You see the crimson numbers and you assume wealth is vanishing. You assume people are dumping gold to buy greenbacks. You are mistaken. The wealth isn't disappearing. It is changing its state of matter. It is migrating from paper promises, which are failing, into physical custody, which is becoming invisible. We need to discuss Gresham S. law and clarify exactly who is buying the floor while you are selling the ceiling. Let's move to part 4. Let's trace the path of the money. Now we arrive at the question that is burning through the internet this morning. Every analyst is pointing at the market valuation of metals. They see the red percentages, and they are shouting that $12 trillion has evaporated into thin air. I'm here to inform you that you're asking the incorrect question. Wealth does not simply vanish. Economic energy is neither birthed nor extinguished. It only shifts its ownership. That 12 trillion didn't go to heaven. It was hijacked. It was relocated from the panicked hands to the disciplined hands in the most significant wealth transfer of this decade. You must visualize the movement of power right now. On one side of the bank, we have the retail speculator. This is the individual who bought leveraged silver calls last Tuesday because he saw a headline about a short squeeze. He is holding a digital claim. He checks his smartphone today. He sees a 36% drop. He reads the frightening stories about Kevin Warsh and the dollar's return. He panics. He thinks his savings are being erased, so he executes the sell order. He realizes the loss. He retreats into the US dollar. He is effectively swapping a 5,000-year-old sanctuary of value for a political currency that is losing its soul, all because a computer graph looked scary for 6 hours. Now, observe the opposite side of the river. Who is standing there? The institutional whales, the sovereign banks, the deep insiders. They are not obsessed with the graph. They are obsessed with the underlying value. They see that the digital price has tanked to $83, but they know the industrial and monetary math hasn't budged. So when the small investor sells his digital contract, the whale captures it, but the whale does not hold the digital claim. The whale immediately demands physical settlement. They are using your digital panic as a coupon to empty the physical warehouse. They are using your fear to fund their hoard. You are selling them insurance on a burning skyscraper for a few pennies. They are accepting it with a grin. This is the modern application of Gresham's law. The principle states that inferior money pushes out superior money. Usually, this means you spend the paper and save the gold. But in today's context, it is more malicious. The inferior money, the dollar and the derivative, is being used to attack the price. But this attack is forcing the superior money, the tangible metal, to go into hiding. Think about the logic. If the computer says the price is 83, but you know your silver is worth 150, are you going to sell it? Absolutely not. You're going to bury it. You're going to remove it from the market entirely. The mining companies will freeze their sales. The smelters will stop their shipments. The shop owners will bolt their doors. The lower the digital price falls, the less physical substance is actually available for purchase. The crash does not create plenty. It creates a vacuum. So, while the television news reports a sell-off, the reality in the global logistics chain is a massive bank run. We are getting data on enormous physical outflows from the major vaults. The metal is shifting from the available for sale category into private, long-term custody, or even worse, it is exiting the banking system entirely. It is flowing into deep shadow vaults. These are hidden facilities in Switzerland, Singapore, and offshore islands that do not publish their balances. Once the metal enters those doors, it is gone forever. It is off the radar. It effectively vanishes from the world's circulating supply. This is the ultimate paradox of the cash is king narrative. By crashing the price to make the dollar appear robust, they are actually speeding up the dollar's destruction because they are letting the smart money drain the collateral at a 30% discount. They are purging the vaults to paint a temporary mural of deflation. But once the vaults are hollow, once the physical movement stops because no one will sell at 83, then the game reaches its end, then the price snaps back with a vengeance. So do not be the victim at this poker table. Do not allow them to frighten you out of your hard-earned position. The 12 trillion didn't die. It moved into the vaults of the people who staged the crash. And if you wish to survive, you must mirror their actions, not their words. You must ignore the digital ticker and focus on the material reality. And that reality is that at $83, silver is unobtainium. It is a myth. Try to find a real quantity. I challenge you. Let's take a walk through the real world and see if your cash can actually buy you any security. I have a test for everyone watching. I want you to grab your phone right now. I want you to open a fresh tab, and I want you to attempt to purchase a single ounce of silver for $83. Go ahead, I will wait. The screen claims that is the value, correct? The exchanges, the newspapers, and the media all agree. They say the worth of silver is 83. So logically, you should be able to trade 83 pieces of paper for 1 ounce of metal. But when you contact your local coin shop, if they even have the lights on, they are going to laugh in your face. They will tell you one of two things. Scenario A, we are entirely out of stock. Scenario B, yes, I have coins, but the cost isn't 83. The cost is 120. Welcome to the era of the phantom price. This is the moment where the digital quote and the physical cost get a divorce. They are no longer in the same zip code. They aren't even on speaking terms. The spot price, that $83 on your screen, is the price of a digital promise that settles in currency. It is the cost of an illusion. The street price, that $120, is the cost of reality. And reality is demanding a massive premium. Think about what that gap truly signifies. When a shop owner asks for $40 over the spot price, he isn't swindling you. He is telling you the truth. He is informing you that the paper exchange is broken beyond repair. He is telling you that the cost to restock his shelves, the cost to actually extract metal from the global supply, has not decreased. In fact, it has spiked because at $83, the mines are going dark. No mining executive is going to blast mountain, process ore, and refine bullion just to sell it at a loss because a computer in Manhattan had a bad day. They are withholding their production. They are putting the bars in the vault and swallowing the key. You want it for 83? Go excavate it yourself. So we have a total supply freeze. The producers aren't selling. The refiners aren't selling. The wholesalers are bunkered down. And yet the paper market insists the value has crashed. This is a mass hallucination. It is a ghost price. It is like walking into a luxury car dealership and seeing a sticker for $10,000. You get thrilled. You run in with your checkbook and the manager says, "Oh, sorry, we don't have any cars, but we can sell you a high-definition photograph of a car for $10,000. That is what the silver ETFs are right now. They are pictures of metal, and the people selling them know they will never be forced to deliver the actual goods. This proves the crash is synthetic. If this were a genuine bear market, if the world truly lost interest in silver, shops would be overflowing with coins. People would be queuing up to sell their silverware just to get some grocery money. The premiums would be zero or even negative. You would be buying below the spot price. But the exact opposite is occurring. The phones are ringing off the hook with buyers. There are buy the dip. Army is out in force, and they are slamming into a wall of zero supply. The result is that the physical market has essentially dried up. You cannot buy size at this valuation. If you tried to buy $1 million of physical bullion today at 83, you would break the dealer's infrastructure. The order would be canceled because the metal doesn't exist at that price. This is the ultimate defect in the cash is king story. Cash is only the ruler if it has the power to acquire things. If you have $1 million in a bank, but you cannot swap it for the asset you need because the market has frozen, then your cash is just a number. You are holding a ticket to a show that was canceled. And this is exactly where the snare closes on the small investor. They dump their silver because they are intimidated by the 83 number. They get their cash. Then, a week later, when they realize the crash was a fake-out, they try to buy their position back, but now the premiums are even higher, or the price is teleported to 150. They exited at the bottom. They cannot get back in. They are locked out forever. They have been purged from the only asset that would have carried them through the coming monetary fire. So when you look at that monitor, understand you are looking at a shadow. The $83 silver does not exist in the physical universe. It is a digit generated by a bank to scare the weak. Do not fear the shadow. Fear the hollow vault. Fear the day coming soon when the paper market finally surrenders and declares an act of God because it has no metal to give. On that day, the price won't just rise, it will go into orbit. We need to conclude this. We need to give you the final strategy for your portfolio in the face of this $12 trillion deception. We need to tell you why staying the course today is the most vital choice you will make for your family's future. Let's finish this fight. Here is the final judgment. We have witnessed them erase $12 trillion of digital wealth in a single session. We have seen them use the Warsh narrative to trick the world into believing the dollar is saved. We have watched them hammer the digital price of silver to 83, a figure that has no connection to the real world. And we have seen the reality. The physical supply has retreated into the hidden vaults of the very people telling you to sell. The conclusion is undeniable. This is not a market failure. This is a liquidation sale for the ruling class. They have carefully manufactured a panic to shake the last of the retail holders out of the system. They want your bullion. They want your gold. And they are prepared to burn the paper market to the ground to acquire it. You are at a fork in the road. Path A, you believe the corporate news, you sell your tangible assets, you take the currency, and what do you receive? You get a token backed by $38 trillion of unpayable debt. You get a currency guaranteed to lose its value every single year, regardless of who is in charge of the Fed. You get a seat on a sinking ship. Path B, you recognize the trap, you hold your ground. You understand that a 5,000-year-old form of money does not become worthless because an algorithm drew a red line. You understand that price is a temporary number, but value is a permanent truth. And at $83, they are practically handing you the only life raft that can survive the coming reset. This collapse is a blessing. Do not waste it. If you can locate physical metal, if you can find a shop that still has inventory, take it. Exchange their fake, dying paper for real, eternal atoms. Siphon every last gram from the banking system until the metal becomes unobtainable for them, too. The paper exchange is in its final death throes. It is screaming and kicking. But the physical world is patient. This manipulation will collapse because, at the end of the day, they can print $1 quadrillion, but they cannot print a single atom of silver. They cannot print gold. They cannot print integrity. Do not let them steal your children's future. Do not let them intimidate you out of your inheritance. The $12 trillion is gone from the digital screens, but the wealth is still on this earth for those with the courage to grasp it. My name is the Commodity Advisor. The price is a lie. The struggle is real. Do not surrender your metal. Keep stacking.